Hello everyone, welcome into Above My Pay Grade. My name is Eric. Thanks for tuning in today. I want to ask a question. If you were to build a house and you were using some kind of measuring tape, and every single time you rolled that measuring tape out, the unit of measurement that was an inch was this, and then the next time it was this, and it was back and forth from one length to another length, and it had zero consistency to it, meaning the measuring tape itself useless, because that tool is there to help you measure certain other tools like wood. That same idea, and I heard this from Robert Breedlove on a podcast, that same idea, if you think about it, applies to the economy and money. Money is just this tool that we use between people to trade goods and services. And there should be a measuring, this tool should be able to be measurable in our head. And if the government says we need inflation, that is saying that we constantly need the change in the measuring stick, the measuring unit. An inch is this? No, it's not. It's this. It's back to this. And what that does to the economy is distort it. It makes purchasing things very difficult. It makes understanding pricing signals very difficult. And a lot of this is ethereal, and you do it in your head and you don't even realize it. When you think something's expensive, think something's cheap, you haggle. All these things happen kind of subconsciously. But on a large scale in the economy, if that measuring stick is broken, if the measuring tape doesn't work, and that measuring tape is money, how well do you think the economy is going to work? It's not going to. So my point is, when you see the article I'm going to talk about today, and you look up any financial news, you're going to see doom and gloom today. And I agree with the doom and gloom. It's not good. The math does not add up. But I like to look at it like, okay, how do we solve this problem? You are going to have booms and busts because human beings are greedy and fearful, but you don't have to have this massive government fiat system where they, like I said yesterday, it's socialism light, it's crony capitalism. You have to fix the money, you have to fix the measuring stick. And until you do that, you're going to have distorted signals in the market, because that's what price is. All price is a signal, right? And price, obviously connected to money. So if money's broken, the signal's broken, right? So from Yahoo Finance here, it says, how to survive the worst bear market of your life. Yes, I think bear markets are coming. I'm by no means a investing expert, but the signs of the stock market and what we saw in the 70s are eerily similar. And if you were around during the 70s, you know. But if you weren't, we had high inflation. We had all-time highs in the stock market in the late 60s. And we had high gas prices. And then the Fed raised rates. And all those together led to about a 16-year period where the stock market didn't do anything. It basically beep, 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 beep. Didn't go up. It went up and down, but it didn't beat all-time highs for 16 years. That's a long time to be investing. So most millennials, all millennials, have never dealt with this. So this will be new for me. So reading from this article, the stock market went up and down, but in the end, absolutely nowhere. The S&P 500 was almost as bad as the Dow Jones. After peaking in 1968 at 108, the S&P stalled and then touched 116 in 1973, stalled again, and then finally broke out in May of 82. It's about 16 years of just sideways movement. And all of that was because Paul Volcker had to raise rates because we are dealing with inflation. Now, when you pour the same ingredients into the bowl, the economic ingredients that we have today, will you get the same outcome? That doesn't always mean the same. It doesn't always mean the same thing, or that you will get the same thing, but something very similar, something that will rhyme. Further on the article, it says, why did the market go sideways for 16 years? What do you know? Mostly soaring inflation, interest rates, and then the Fed having to, soaring inflation and interest rates, so the Fed having to raise the rates. So today, we have a Federal Reserve that is saying, we're going to raise, and we're not going to stop until we get to our 2% target. What is different? So I talked about the ingredients of the 1970s. So high inflation, Fed raising interest rates, high gas prices, led to sideways market movement and not a lot of GDP growth in the 1970s. Why aren't we going to see the same thing today? My contention is going to be worse. One thing we didn't have in the 1970s that we had today was a massive amount of debt, government debt. And when the Fed raises interest rates, that raises the interest rate on government debt. And the government pays, can anyone guess, approximately $350 to $400 billion a year in interest, only interest, not principal, on its debt today. And that's about 1 to 1.5%. Do you think if Treasury rates raised to 4%, essentially doubling what the federal government is paying on its interest, that would match the entire DoD spending? So DoD spending and interest, the largest army in the world, the most powerful army in the world, is matched by the interest payment of that same nation. Mind-boggling and mind-blowing. So what is different today, the 1970s, we have massive amounts of debt, and if interest rates are going up and people want, if inflation is here, 7%, 8%, what person is looking at a government treasury and saying, I want to take a guaranteed 2% a year? So guaranteed loss. What entity is doing that, do you think? And how long do you think they will do that? I think people are rational. I don't think they look at 8% inflation and 2% interest rates on treasuries, maybe 3 or 4, whatever it is. If it's below inflation, they look at that and think, I don't think that's a good deal. And they would be correct. Okay? So the Fed has told us that they have planned not to make the same mistake they did in the 1970s. That was raising rates and then easing off and then having to come back and raise rates again. So Jerome Powell has had this kind of hawkish stance. Again, this goes back to the actual problem we're dealing with. The actual problem is the money itself. But we're in the quagmire. Okay, so let's deal with the quagmire we have. But in order to fix the problem, we have to fix the money. But we're in the dollar-based system today. Jerome Powell has said that he is not going to reverse course, and he's seemed more hawkish than people thought he would be, more disciplined on his rate hikes. And people are kind of like, is he going to watch the economy fall apart, potentially go into a depression in order to cure inflation? I don't think so. Why? Politics. Because politics is a 4-year cycle, and if you don't think the Federal Reserve is political, you haven't been paying attention. So do I think that we're going to see 2% inflation in this country? No. Fortunately not. I don't think Jerome Powell is going to be able to stick to his guns. I think he's going to break the bond/treasury market, and that will be the pivot point. But we will have a massive recession on the way. Let me know what you think. Do you think Jerome Powell actually has the stomach or let's say the cojones to stick through even a depression to get us below 2% inflation, or at 2% inflation, which is his target. I don't think so. Let me know in the comments below. See you guys in the next one. Peace.